Make and buy decisions. This topic is based on 2 books. Managerial Accounting written by Garrison, Noreen, and Brewer. Management and Cost Accounting written by Drury. For more information, please visit the e-learning platform. By Karim Sharf. Making decisions is one of the basic functions of a manager. To be successful in decision-making, managers must be able to tell the difference between relevant and irrelevant data and must be able to correctly use the relevant data in analyzing alternatives. The purpose of this session is to develop these skills by illustrating their use in a wide range of decision-making situations. A relevant cost is a cost that differs between alternatives. It is important to realize that every decision involves a choice between at least 2 alternatives. The goal of making decisions is to identify those costs that are either relevant or irrelevant to the decision. Costs and benefits that differ between alternatives are relevant in a decision. All other costs and benefits are irrelevant and can and should be ignored. Relevant costs and revenues are future costs and revenues that will be changed by a decision. Irrelevant costs and revenues are those will not be affected by the decision. Irrelevant costs are unaffected by management's actions. For example, if you are faced with a choice of making a journey using your own car or by public transport, the car tax and insurance costs are irrelevant since they will remain the same whatever alternative is chosen. However, petrol costs for the car will differ depending on which alternative is chosen, and this cost will be relevant for decision-making. An avoidable cost is a cost that can be eliminated in whole or in part by choosing one alternative over another. Avoidable costs are relevant costs. Unavoidable costs are irrelevant costs. 2 broad categories of costs are never relevant in any decision. 1. A sunk cost is a cost that has already been incurred and cannot be avoided regardless of what a manager decides to do. 2. A future cost that does not differ between alternatives is never a relevant cost. Relevant cost analysis is a 2-step process. The first step is to eliminate costs and benefits that do not differ between alternatives. These irrelevant costs consist of sunk costs and future costs that do not differ between alternatives. The second step is to use the remaining costs and benefits that do differ between alternatives in making the decision. The costs that remain are the differential or avoidable costs. For example, you are considering visiting your friend in Paris. The annual cost of auto insurance is a future cost that does not differ between alternatives, so it is never a relevant cost. The cost of the car is of sunk costs. Costs that are relevant in one decision situation may not be relevant in another context. Thus, in each decision situation, the manager must examine the data at hand and isolate the relevant costs. Assume the following information for a company considering a new labor-saving machine that rents for €3,000 per year. The total approach requires constructing 2 contribution format income statements, one for each alternative. The difference between the 2 income statements of €12,000 equals the differential benefits shown at the bottom of the right-hand column. The most efficient means of analyzing this decision is to use the differential approach to isolate the relevant costs and benefits as shown. Using the differential approach is desirable for 2 reasons. 1. Only rarely will enough information be available to prepare detailed income statements for both alternatives. 2. Mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is really critical. One of the most important decisions managers make is whether to add or drop a business segment. Ultimately, a decision to drop an old segment or add a new one is going to hinge primarily on the impact the decision will have on net operating income. To assess this impact, it is necessary to carefully analyze the costs. Let's see how relevant costs should be used in this type of decision. Assume that Lavelle Company's digital watch line has not reported a profit for several years. Accordingly, Lavelle is considering discontinuing this product line. To determine how dropping this line will affect the overall profits of the company, Lavelle will compare the contribution margin that would be lost to the costs that would be avoided if the line was to be dropped. Lavelle should drop the digital watch segment only if its profit would increase. This would only happen if the fixed cost savings exceed the lost contribution margin. Assume a segmented income statement for the digital watches line is as shown. An investigation has revealed that the fixed general factory overhead and fixed general administrative expenses will not be affected by dropping the digital watch line. The fixed general factory overhead and general administrative expenses assigned to this product would be reallocated to other product lines. The equipment used to manufacture digital watches has no resale value or alternative use. Should Lavelle retain or drop the digital watch segment? Contribution margin approach reveals that the contribution margin lost, €300,000, exceeds the fixed costs avoided, €260,000, by €40,000. Therefore, Lavelle should retain the digital watch segment. In other words, dropping the product line would decrease the company's overall net operating income. This result reveals that Lavelle would earn €40,000 of additional profit by retaining the digital watch line. Lavelle should drop the digital watch segment only if its profit would increase. This would only happen if the fixed cost savings exceed the lost contribution margin. Comparative income statements can also be prepared to help make the decision. Let's look at the second approach. These income statements show that if the digital watch line is dropped, the company loses €300,000 in contribution margin. The general factory overhead would be the same under both alternatives, so it is irrelevant. The salary of the product line manager would disappear, so it is relevant to the decision. The depreciation is a sunk cost. Also, remember that the equipment has no resale value or alternative use, so the equipment and the depreciation expense associated with it are irrelevant to the decision. The complete comparative income statements reveal that Lavelle would earn €40,000 of additional profit by retaining the digital watch line. When a company is involved in more than one activity in the entire value chain, it is vertically integrated. A decision to carry out one of the activities in the value chain internally rather than to buy externally from a supplier is called a make or buy decision. Assume that Essex Company manufactures Part 4A with a unit product cost as shown. Also, assume the following information as shown with respect to Part 4A. Given these additional assumptions, should Essex make or buy Part 4A? The avoidable costs associated with making Part 4A include direct materials, direct labor, variable overhead, and the supervisor's salary. The depreciation of special equipment represents a sunk cost. Furthermore, the equipment has no resale value, thus the special equipment and its associated depreciation expense are irrelevant to the decision. Remember, a sunk cost is a cost that has already been incurred and cannot be avoided regardless of what a manager decides to do. The general factory overhead represents future costs that will be incurred regardless of whether Essex makes or buys Part 4A. Hence, it is also irrelevant to the decision. Remember, a future cost that does not differ between alternatives is never a relevant cost. The total avoidable costs of €340,000 are less than the €500,000 cost of buying the part, thereby suggesting that Essex should continue to make the part. Special order is a one-time order that is not considered part of the company's normal ongoing business. When analyzing a special order, only the incremental costs and benefits are relevant. Since the existing fixed manufacturing overhead costs would not be affected by the order, they are not relevant. Remember, a differential costs or incremental costs is a difference in cost between any two alternatives. A difference in revenue between two alternatives is called differential revenue. Assume the following information with respect to a special order opportunity for Jet Incorporated. Should Jet accept the offer? Contribution format income statement for Jet Incorporated's normal sales of 5,000 units is as shown. Assume variable cost is €8 of unit. Total variable cost would be 5,000 units times €8 of unit. If Jet accepts the special order, the incremental revenue of €30,000 will exceed the incremental costs of €24,000 by €6,000. In your opinion, the company should accept or reject the order. If Jet accepts the offer, net operating income will increase by €6,000. This suggests that Jet should accept the order. Notice that this answer assumes that the fixed costs are unavoidable and that variable marketing costs must be incurred on the special order. Thank you for watching.